In terms of risk mitigation, what approaches would you recommend, particularly for this asset class, particularly with regards to private securitization structures?
If you analyse the partners you're working with as being set up to detect these risks, and that you're monitoring the kind of end of the market you're operating with and the prevalence of fraud in that market.
My name is Deepesh Patel, editor at Trade Finance Global.
I'm Nick Stainthorpe, I'm a partner at Reed Smith.
Welcome to Trade Finance Talks, your go-to trade, treasury and payments podcast, brought to you by TFG. Today we're at the Trade Finance Investor Day in London because the trade and receivables finance industry is always on the lookout for alternative investors. But compared with assets like mortgages, trade and receivables finance is perceived to be much more complex, which makes it challenging for new investors to navigate the market. Securitization has the potential to unlock and diversify the source of capital available to the trade and receivables finance assets. By packaging trade finance receivables and other assets into securitized instruments, originators can access a much wider pool of investors, including those who may not have the resources or expertise to invest directly in those underlying assets. Today, I'm joined by Nick Stainthorpe, partner at Reed Smith, to explain how securitization can act as a bridge from new liquidity to asset originators. Nick, welcome to Trade Finance Talks.
Hey Deepesh, thank you very much for having me. It's a pleasure.
Thank you. So, quick introduction, elevator pitch. Who are you? Where are you from? And what do you do?
I'm Nick Stainthorpe, I'm a partner at Reed Smith. I'm a structured finance partner. I've been packaging trade finance risk in different ways for approximately 20 years. And in that time, I've seen very many different ways of going at this and the successes and the odd challenge along the way. So it's great to be here to talk to you about it.
Let's take things back to the basics. What's the kind of main difference between asset-backed securitization and I call it private securitization? And why more generally is securitization important for the packaging of trade finance assets?
Dealing with this in turn, securitization can be either public or private, which is, I think, not really what you're getting at with the question. But to start with, private securitization is something that's not sold on the public markets, on the listed public markets as a liquid or even illiquid capital market instrument. Private securitization is basically just setting up a company or some other kind of entity to buy receivables. And in that way, you separate those assets from the seller. And that company can be funded with loans, doesn't have to have anything to do with securities. It's purely the process of ring fencing assets. The counterpoint to that is to just lend to the company and take security over them. So ring fencing the assets gives some very material advantages if the seller has some kind of insolvency issue. So I think what you're asking with asset-backed securitization is more alluding to proper capital markets transactions where you are issuing securities which may or may not be listed and probably in some kind of clearing system, and that's designed for your more passive real money investors. So those are the two different alternatives. And look, in the world of trade finance, there's very little, that's almost nothing that's done on the public markets. On the kind of asset-backed proper capital markets, there are definitely deals out there, but the larger subset of that would definitely be private securitization. So why do people do it? Investors, as you say, want to invest in trade finance, and this product, i.e. securitization, is in the level of, any private securitization means you're ring fencing the assets from the bankruptcy estate of the company that's selling them to you. So that's a good thing. The next level, you're getting them. So in a kind of asset-backed securitization, you're doing that. And you're also getting those in this investment in the form of securities, probably in a clearing system, and perhaps with a rating, and perhaps with some other features that make them more attractive than the underlying assets. Which, while it's possible for real money investors to invest in them, that is laborious and difficult. So, the securitization market adds the benefit of being able to rely on partners and specialists to package up the assets and manage them in a way that hopefully delivers a better outcome for the investor.
Thanks, Nick. So we'll focus here on private securitization, and also as per your brilliant panel session and presentation earlier, What are the primary risks investors encounter with trade finance-backed securities and those who typically invest in these assets?
There are risks which are general to investing in securities, like ultimately your main exposure is to the underlying debtors. So you've got credit risk, and that's exactly the same if you're investing in a portfolio of mortgages or leases or some other securitizable asset. And then you have some risks which are not unique to trade finance, but which are, certainly a feature of trade finance more than are in some other asset classes. So, for example, you need to be careful about dilution risk, which is a risk when the receivables you're financing reduced because of defective products or services or disputes. You have to be mindful of fraud, which can happen in any type of financing because you're financing such a often diversified portfolio of underlying assets with different trade relationships and frankly different people involved. There are some risks there which are potentially more acute than they are in the case of residential mortgages, for example, or corporate loans, where it can't happen in quite the same way. So there are some unique challenges. On the other hand, the industry is very much set up to mitigate these risks. And as long as you're doing your due diligence carefully and working with the right partners, these should be things that don't affect the overall outcome.
Are there any specific risks that you see within the trade finance space?
There's nothing that's completely unique to trade finance, but certainly diving a little bit deeper into the possibility of fraud risk, for example. If what's ultimately being financed is invoices for the sale of goods, there is a risk that an originator, so someone who's selling assets into the transaction in some way, issues invoices because they need the money, because of some desperation or even through some kind of criminal undertone, issue invoices for goods that have never been delivered and don't exist. And no more innocently, in fact, perhaps more commonly, there's the risk that they finance those invoices with more than one person, so they sell the invoices twice. Then there are risks of something called carousel fraud, where an originator might collaborate with a debtor. So they might do a kind of dummy transaction where money changes hands and then do a large transaction where the purchaser says, I've received the goods or whatever, but in fact there were no goods, or the value of the goods is exaggerated, and then both of the companies collapse when they've extracted enough from, well, as much as they can, but potentially. So, those specific forms of fraud risk are things that arise because the underlying business is the supply chain. It's, the sale of goods. That's why you have those peculiarities. It doesn't work so well with just a straightforward corporate loan because the borrower is still on the hook. So they may or may not pay back. They can't fraudulently not pay back because they're not being asked to show an invoice, demonstrate an asset in the first place.
Hey, enjoying this podcast? Hit that follow button for more. Done? Let's get back to it. Thank you, Nick. So we've talked about the financial risk side, the legal risks, and credit risk, dilution risk, fraud risks, and perhaps a little bit more unique and specific to trade. There's the duplicate invoicing piece and carousel fraud. In terms of risk mitigation, what approaches would you recommend, particularly for this asset class, particularly with regards to private securitization structures?
I think there are some things I would recommend too, and then nothing's perfect. Occasionally you get extremely large and reputable companies, because there are bad actors present or some sort of distress situation, do dishonest things. But generally, if you analyze the partners you're working with as being set up to detect these risks, and that you're monitoring the kind of end of the market you're operating with and the prevalence of fraud in that market, you can have some visibility on how likely these things to occur. On the other side, on the purely human side, we see people, where someone's a critical partner to a business and they're not a well-established company, you might see background checks being carried out on them to try and detect any past misbehavior. It's now catching out dishonesty is not straightforward. It's often not that easy, but through responsible and due diligence and monitoring to ensure the numbers add up and documentation, etc., is consistent with the cash flows through the business, and perhaps sample checking of invoices with the debtors and various other steps, you can mitigate those risks. One thing you cannot do is insure against, well, not so far as I'm aware, is insure against fraud risk. It's a risk that needs to be solved through different routes.
But on the topic of insurance, how does credit insurance help support risk management in receivables and trade finance?
Yeah, this is something we've been involved in for many, many years. starting with the use of trade credit insurance, which is a product that's designed for normal sellers of goods to insure against the risk that they have, and has been adapted more and more to work for financing transactions. So in addition to giving them that protection, it also gives them access to finance at costs they wouldn't otherwise have. Clearly, they have to pay the premium, so it's not entirely straightforward. That's where, at least where my journey started on that. But then also you have more pure credit risk products, which are designed for non-payment on to protect against non-payment on loans. When you get into the world of using insurance in finance, it's not something to be, I don't think anybody would take it lightly, but it's something which requires knowledge as to how the insurance market works and how you mitigate the risk, for example, of an insurer subsequently saying that you didn't disclose the risks to them properly. Insurance generally won't cover 100% of a risk ever, so almost always there needs to be someone who's taking skin in the game in some way, which provides a great deal of comfort to insurers, and that's something you need to be aware of. So, wrapping, and I have seen insurers pay out on claims, and we have been involved in claim situations, some of which were easier than others. So, in short, I think it's a good thing, but it's not to be taken lightly. It requires some work to get it right.
Let's talk about the SME trade finance gap, and it's a topic very close to my heart, and we actually released a white paper on this just yesterday. How do you see the role of securitization changing trade finance? Do you think it will help or can help reduce the 2.5 trillion SME trade finance gap? And do you anticipate any shifts in regulatory approaches or the structuring of these instruments?
SME financing is also something which is close to my heart. Obviously, people go at that in different ways. There are some basic non-legal challenges to do with SMEs, such as obviously financing large numbers of small counterparties and multiple small invoices is something that requires systems that have been developed for that purpose. And clearly, SMEs go bust much more than larger companies do, and it's harder to monitor them than financing a smaller portfolio of larger companies. I think also when people talk about the trade finance gap of SMEs, I don't think it's that all SMEs are crying out for finance. If you just take all receivables in the supply chain and consider that to be an opportunity for financing, that's only half true. And as much as, they have to, and it may be a question of people not realizing that they could get a better business if they had access to liquidity more quickly, which of course costs them something. On the other hand, we shouldn't assume that every business wants to finance the trade finance gap. It's something that's been talked about for a long time for the non-bank sphere, because we know that banks have trouble with just the volumes that concerned, and for setting up the APIs and interfaces to allow it to do this in a more automated way. So I think it's something that can and will grow, and clearly you're competing with other products too, like just lending to SMEs. So I see it both as an opportunity, but not always as quite a big of an opportunity as some people perceive.
An interesting take there. So I guess here we are at the Trade Finance Investor Day. For those investors new to trade finance backed securities, what considerations would you say that they should take into account before entering this fairly unusual market?
That's a great question. So someone coming at this completely cold from the outside, I think they need to take the time to understand this product, even if there's a credit rating, for example, because, when you're buying packaged securities and you've got a credit rating on them, then it should be completely asset agnostic. But clearly, your due diligence needs to go deeper, even if you do have the benefit of a rating, because you can't pursue a rating agency just because their rating is wrong. And that's also true of insurance. You don't need to worry about credit risk anymore, or in the other types of risks that we've been talking about today, like operational risk, dilution risk, etc. The first thing is to take time to educate yourself about this product, to look at different partners and investors who are operating the market already and compare and contrast the way they do it. I think you should hire the right advisors, hint, with experience in this product to steer you in the right direction. Taking all those things into account, if you make the investment necessary to understand the product, I think there's a lot of potential here and a lot of people trying to make it work. And look, it's a great asset class, uncorrelated to things like real estate values or corporate valuations. You're financing relatively short-dated underlying assets with long-term investments. In some cases, you're getting, for example, SMEs who are prepared to pay the financing cost that an SME will pay, but the credit risk is much more creditworthy than that cost of finance would imply. So, there are some beautiful things to do here, but go into it carefully and make sure you become acquainted with the market.
Thank you very much. That was Nick Stainthorpe, partner at Reed Smith, giving us some insights around private credit and securitizations at the Trade Finance Investor Day. Thanks for joining us, Nick.
My pleasure. Thank you so much.